Good morning, almost good afternoon. And we're going to talk about where we are and how we're working through these changing times. I'd like to take a moment and introduce the panel. Most of you know who they are, but let me go through the formality of introducing who they are. First to my left is Charles Ostroff, Senior Vice President, Chief Credit Officer of Fannie Mae. Charles, nice to have you here.
Thank you for having me.
Robert Verrone, Principal and longtime friend of Hound Capital Management. And Aaron Kurlansky, Principal of Sheridan Capital and FM Capital, I think on the shoes over there.
Yeah, you can see from the shoes. So.
Now, I will tell you this. I don't think these three agree on a lot of things, but they do agree that we're going through changing times. And one thing they do have in common is this is not their first rodeo. Before we get into an open discussion on the panel, what I'd really like to do is give a little perspective of kind of how we got here. Because I think as we've had such a phenomenal run the last couple of years, we really forgot where we were 10, 12 years ago and what we went through. So I'm going to get a little technical, just so we could set a foundation a little bit and walk through these slides so we can get a good understanding for what's really happened over the last decade. We almost forgot about the period of 2010 to 2019, which for us in the multifamily sector was the greatest run that we've seen, at least in my lifetime in this business. We saw rent growth for 10 consecutive years. We saw vacancy rates at historically low levels below 5%. We saw household formation outpace supply. We saw investment volume at historical highs and cap rates falling well below 5%, which, you know, everybody thought was the new norm. And we saw just a huge growth in origination values. This was the longest expansion in US history. We saw unemployment hit a 3.5% rate, which was unbelievably low. We had low interest rates and low inflation. What you can see in this chart is that things started to level off in 2019. I think actually in 2019, pre-COVID, you started to see the beginning of a correction. The correction was occurring. Rates started to rise. Rent started to flatten out. We all forgot about that. There was a correction that was taking place. Clearly, you can see the trend. You can see the trend of cap rates declining rapidly. You could see interest rates were going down, and then interest rates started to correct. Then what happened? Then we had the pandemic. And this is really important to understand the pandemic, what happened, and how it created huge values in the multifamily sector and really created a lot of fundamental issues. So we had the shortest recession in US history. We all remember it. Unemployment jumped to an unbelievable, unconceivable level. So what happened? We had 14.7% unemployment. We had $5 trillion in stimulus put into the system. We saw consumer debt decreased to kind of the lowest levels ever seen. We had householding savings increase to a very high level, and we had huge pent-up demand. What are the effects of all of this? We had a flight to the suburbs and remote work, historically high rent growth, unprecedented home price appreciation, housing supply was low, demand was high, and then we had, of course, supply chain interruptions, low population growth and migration, and retail sales increased. And what do we have? Inflation, runaway inflation. If you take a look at this chart, you can see exactly what happened. We had a trend of unemployment dropping. We had a spike in unemployment, and now we're back at a period of time where we have exceptionally low unemployment. We saw the consumer price index, inflation, skyrocket and have runaway inflation. Why am I going through this? Because this will really explain where we are today and how we have to correct, and kind of my outlook, and a lot of people on the panel do have a similar outlook because they've been through so many cycles. The next slide is extremely important. It's kind of contrary to what people think in terms of what I'm going to say, but you can take a look at this slide and see that before every single recession, you have the lowest unemployment rate. And every time you have a recession, you have a spike in unemployment. Now, if you're listening to all the news, if you're listening to all the data, everybody's saying, no, no, that's not what's taking place. Unemployment remains low. There are huge job openings. They're going to be filled. I firmly disagree with it. I think the only way to correct where we are in this cycle is for unemployment to rise. And you're going to see it. Otherwise, you won't have a correction in the system because you won't have a supply chain correction. You won't have a price change correction. This recession won't correct until CPI gets under control and employment gets under control. Okay, this gives you a little bit of an outlook of what happens in a recession when unemployment becomes a factor and the road to recovery. If you look at the long line, it's one that we've seen in our lifetimes. That's the yellow line. That was the longest recovery of any recession that occurred to get back to full employment. This also tells you what happens and how cycles work. Every time there's huge money poured into a sector, particularly our sector, right? The sector gets built up, and you can see each time you hit a recession, and it's very clear that we have a huge amount of investment in our sector, and it's very clear to me that we are in a recession. It's not on this chart because it hasn't been officially declared. If you look at multifamily housing starts, we're at record numbers. We have a lot of units to deliver, and this is once again a sign that we are in a recession. What's happening and where do things look like they're going? Take a look at the job openings. I actually think this data is misleading and it's going to change. You're going to see the job openings really drop tremendously, and you're going to see the unemployment numbers change. You're going to see the number of quits change, and you're going to see the number of layoffs change dramatically. And that's what's going to create unemployment. CPI, we all know where it is. Let's talk about rent growth. Rent growth accounts for over 1/3 of CPI. If you're going to continue to have rent growth, then you're not going to have a drop in CPI. So my outlook, and the outlook we have, is you're going to have flat rent growth. Otherwise, you're not going to have a correction of CPI. Personal income and spending. Clearly see personal income and spending has gone up. You surely see the personal savings rate has gone down. We're at one of the lowest levels in personal savings rate, gone from some of the highest rate. Delinquency rate in credit card loans, you're seeing credit card loans and delinquencies go up. You're seeing the amount of consumer debt go up and skyrocket. We all know what's happening to home prices. You're going to see a really big gap down. You're not seeing it yet. It's falling, but we think it's going to fall more dramatically. And the stimulus, we all know where the stimulus is. $5 trillion put into the system. You can argue where is it, what is it. It's a lot, but that's all drying up as well. So my outlook's very clear. My outlook is that we are in a recession. My outlook is that inflation has to come under control and that we're in a real corrective period of time. That's where we are at the moment. I think there's real capitulation. We got to understand where we are with cap rates. With that, I'm going to open up the panel and turn it over to Charles.
Well, Ivan, you went through a lot there. I'll try not to be as broad. Anyway, with cap rates, what we're hearing from people that we meet with is there's still a disconnect between ask and bid, right? And we've heard upwards 20%. And to correlate that, what I've said to a lot of people is, I get a 2% mortgage rate. I don't mind overpaying, right? But if my mortgage rate's in the 6s and the 7s, I'm not going to want to overpay. And with the disconnect that's going on and a few of the players that I've spoken with, no one tells me that they're on the sidelines. Everyone says, I'm in a pause. And the activity stopped because of, I always talk about people fall in love with bricks and sticks and that they're living in, 2018. Well, prices aren't 2018 anymore, it's 2022. And we're gonna need that adjustment. So there's definitely been a lag. We've seen some upward movement, but probably not at the levels that you would think with the way that interest rates have gone up.
Robert, you're next on the panel. You've been a lender, you've been a restructurer, you're a broker, you represent a lot of people in a lot of different environments. You've seen a lot. Where do you think we are in this cycle? How do you see things going on?
I guess, I never think it gets as bad as people think it's going to get. I'm absolutely negative, right? We have rates are going up, spreads are going up, and cap rates are going up, right? So all three things that affect value are going in the wrong direction. I never think it gets as bad as it gets. I mean, people have term on their loan. Lenders usually are willing to kick the can a little bit. And if you have some money to bring to, listen, if you have some money to bring to the table, you'll kick the can and you'll ride it out. That's kind of what we have seen for a long time. But it's going to get choppy. It's going to get ugly.
Yeah. You and I were talking because we've been through a lot of cycles together, and specifically on the multifamily side. And I've always had the view that in multifamily, every high is followed by another high. And you've advised your clients a lot, just figure out, how to position yourself well. And, that's a fact. On multifamily, every high is followed by another high. And getting through a down cycle is just, part of a cycle. If you can get through it effectively, and that's where they come to Robert to try and help them get through it a little bit, you always end up coming out the other side. What's your opinion on that attitude?
I think once borrowers realize, like every borrower wants a lender in good time and a partner in bad times, and that never works with the lender. So if you have cash, and I always say if you're not a thief, if you're competent and you have cash, you should be able to get a restructuring and you should be able to buy some time. And we have seen that happen more often than not. More often than not.
So Aaron, you and I go back a long way as well. You've been a borrower, you've been a lender, you've been a partner. We've owned a lot of stuff together. You run a couple of different firms. I know you're very active on the lending side. You're very active on the ownership side. You and I have been talking about providing capital, to different borrowers, because sometimes in syndicated deals, it's not as easy to access the capital. Talk to us a little bit about, some of the opportunities you're seeing in recapitalizations and where you think the market is in adjusting.
Yeah, so, one thing is it's multifamily, it's not office, so that's good, so at least the asset class as a whole is not, on the way out. So that's a good foundation. The other thing is a lot of these deals are going to need to be re-equitized. And, with syndicators, cash call is like a 4-letter word for people. Investors usually think only money goes out, and everything goes well. But there are times where you got to pony up and ride out the wave. And, with this type of thing, with the rates moving up so quickly, eventually they will come down. Is that a year, 3 years, 5 years? Who knows? But the asset class is sound as a whole. So there's going to be a ton of opportunity to either recap deals, offer pref and whatnot to help everyone essentially kick the can down the road until times are less volatile and choppy.
So let's assume a borrower comes over to Robert and says, hey, I got this great lender, Arbor, who's willing to work with me. And I need some recap money. Arbor wants to do it, but they're probably a little expensive. And he calls you up and he says, okay, we'll work together. How do you do that? How do you determine value? How do you determine your contribution? What becomes your basis to do that so I can get a loan and a good borrower?
Right. That's a good question. So what Rob mentioned, first of all, not being a thief is actually like super important for lenders. It sounds stupid, but it's like to be actually open and honest with your lender it cuts through all the bullshit because it saves them weeks of underwriting, which they're going to find anyways. So just be open and honest. Actually, as a borrower, know your market and know your asset. Like really know your asset better than we do. So, and then, be willing to come up with some kind of structure where you're going to lose a little, and the lender's going to, so that the lender is able to work with you. You can't hold firm and expect everything to be 2021, 2022. You're going to lose a little, but it's all for the greater good of everyone. In terms of valuation, I mean, we'd value it based on today's rates, which, today's cap rates, which probably means that half of the equity, if you bought a deal in the last couple of years, half your equity has been eroded, and you're basically going to get crammed down by 50% based on the math today, I would say.
It's much easier to recap a deal with your own money, because like you and your partners, you still believe you bought the thing for 30 million bucks, it's worth 20 now, but you told all your friends it's worth 30. It's much harder to recap a deal with third-party money.
Yeah.
Like the probability of success, I don't care if there's 100 guys lined up here with cash, they don't want to invest in a level where the lender's going to let them feel comfortable to invest in.
And how have you found working with different lenders and their intercreditors and them putting you at a seat at the table? Does that create a level of complexity in restructuring a transaction?
Yeah, listen, it's crazy. When I used to be a lender, we closed loan docs. We closed $30 million apartment loans for $6,000. That was the legal fee. Now it's 60 grand. We still don't, you really don't care what the loan docs say in a lot of these workouts, because at the end of the day, the most important thing is what is the property worth. Right now, a lot of borrowers make mistakes and they sign things they shouldn't sign, or they maybe didn't think that those provisions had actual teeth, and we have to navigate them. But the loan docs in my world, typically, we make love, not war, is secondary. Like the first thing is what is the property worth and what's the solution?
Now, Charles, at Fannie Mae, most of your portfolio is fixed, or a good percentage of it, so it's pretty well protected. And most of your stuff that's running off is, 8, 10 years old, so it's in the value. Talk to me about Fannie Mae's appetite for originating loans for next year, where they see the cap coming in, how aggressive you're going to be. I mean, fixed rates are going to be pretty high, right? So you're looking at a 6% fixed rate, 6.25%, 6.5%. Where do you think your volume is going to come from?
We're hoping the affordable space, right? Our mission, because historically it's an area that hasn't been focused upon, right? And there's also people out there that, everybody talks about dry powder, that are still looking. But the panel that was up before, the money's going to have to be short money. Everybody's going to want shorter, whether it's term or prepayment period, or even a step-down prepay. But what I'll say is that, the step-downs probably haven't been pricing as well as they used to, and but it's an option, right? And as far as bringing in, it's going to come anywhere from assumptions, right? Think about assumptions that are out there, have a lower rate, somebody coming in for a supplemental. Counts against our volume, but it doesn't help us with housing goals, doesn't help us with mission, anything else. So it's going to be some of the bigger players. I don't think anybody's going to be getting involved, right, for the first time. But, in what Rob was talking about before, right, the people that are out there and that are overextended, right, we're not the savior. We're not their partner. We're not their JV partner.
But you just said people are going to want short term.
Short term.
So all they're doing is making a bet on treasuries. Like, why buy apartments, short or go long U.S. government bonds, right? How do you know that, 2 years from now rates aren't 12% or 13%, right? So everyone's like, rates are going to go down. Rates are going to go down. Like, everyone's got to stop trying to predict interest rates, and the deal's got to work. Because if you're going to predict interest rates, you should be running a hedge fund somewhere and managing money and making 2 and 20. I mean, it's not.
To me, I think it's less about predicting and more about comfort level, right? That someone doesn't, we've seen it for God knows how long. Mentally, somebody wasn't being tied into this rate for too long, right? Not saying that it's the right move, but that's where they are mentally. That this is where I am, and I want that flexibility.
Yeah, and also everyone that buys, everyone says they're long-term holders. No one's a long-term holder. There's like 2%.
Can't get to promote.
Yeah, I'm also a long-term holder. I'll sell it tomorrow, if you hit the right price. So, so everyone says long-term, so no one wants to lock in fixed money, because if there is an event, everyone's cashing in and selling.
Robert, if your point of view is that we're in a new interest rate environment and this is the way it's going to be, you're going to see cap rates go up to 6.5%.
My point of view is I've not found anyone that could accurately predict interest rates or spreads. In whatever many years I've been doing this, if anyone could predict it more than 50% accuracy, they wouldn't be in this room. They'd be in Sweden with $100 billion in the bank just buying and shorting treasuries and other products. No one in this room will put their life savings to predict where interest rates will be 12 months from now. No idea.
So Charles, when you're looking at, agency loans right now, talk to me about the cap rate philosophy on the underwriting side. Where have you adjusted cap rates to? And then I'd like to know, Aaron, on the buy side, how does that match up with, where you're looking at them as you're buying assets?
So I don't know about adjusting, right? Because we review our portfolio all the time, and we put a floor in. That floor will change with the market. It's not that, our floor is 3%, we'll put everything at 3%, right? Depending upon the market, that we will change it and look at what is going on. You asked an interesting question about how we're looking at deals and what we're doing, and I've said this before and I'll keep repeating it. It's COVID reinforced to me the basic premise of know your customer. That everybody talks about people acting appropriately. I think Aaron said, as long as, not being a thief, we talk about acting, as appropriately as a lady and a gentleman. And if that's the case, those are the people that we would like to do business with. As far as valuations, right now, right, we have the benefit of a lot of the deals that we have a rate that's not the rate of today, right? They've locked in already, and we're looking through. As far as going forward, anybody who knows me knows I'm not a fan of appraisers and appraisals. I truly believe that, within my own organization, people can probably value better than an appraiser. And we all know appraisals are a 6-month look back. So if there's nothing trading, right, and they're taking a number and they're putting something on top of it, well, what is that number? And then you have the argument of it's worth whatever someone is willing to pay for it. But the flip of that is we all know not everybody's smart, right? And people have to deploy capital and make their money. So it's something from a cap rate perspective we're getting a lot of pressure about, a lot of questions about, and something that we are very focused on, right? That, again, as we pointed out, we know the valuation is down. It is down, but it's a matter of how much.
It was interesting, about 6 months ago, cap rates were still 3 3/4 and 4%. And I would talk to a lot of people saying rates have gone up, the math just doesn't work. And everybody was very obstinate. They basically maintained multifamily is the best asset class, that's where it's staying, you're crazy. And clearly 4 or 5 months later, everybody was like, wow, it's 5%. It actually went from 4 to 5, like within an instant. And what's your point of view in terms of where we are cap rate wise and what you see as a really good value in terms of buying and recapping?
So I can't believe I'm the optimistic person here on this panel, by the way. So for one thing is, I think multifamily investment is probably, and the equity is really dictating pricing for people because syndicators are going to go by, whether it's $10 million or $11 million, it doesn't really matter to a syndicator, it matters to the equity. And the equity is the one saying, retrade, lower the price, I need to be at this cap. But really, what you want, but the equity still does want to buy multifamily versus whatever else is out there. Stock market's crazy. Bitcoin, I still don't understand, and things like that. So there is still value there. The other thing is, though, if your mortgage rate's 6 and you're buying a 6 cap, there's very little arbitrage on the spread there between if you're borrowing 70%, 75%. So you want some positive arbitrage between spread and cap rate, and there isn't now. So I would assume as rates move up, cap rates are going to have to move up. The way that we're looking at it, very simply, if rates are 6 and you're buying a 6 cap with some upside, that's probably an interesting deal, but not there yet. But there probably has to be like a 50 basis point spread between what your rate is and the cap rate for it to be interesting.
The whole world are these guys, right? What Fannie does and what Freddie does is going to dictate everything, right? So we could talk about what FM Capital does or Wells, but at the end of the day, it's these two guys. They're 90% of the business, and If they decide to get really greedy, it could be an issue. If they,
I don't think we're 90%.
whatever you are, but if you step up like you did in 08,
Single family, but not on the
right? You refinanced all your loans, you gave borrowers breathing room, you made 08 a little less painful. So I think we'll follow your lead a lot.
Listen, '08 was an interesting time because there was no liquidity in the market on the multifamily side or any other side, and the agencies provided liquidity. But then you saw rates decline, right? And then you saw multifamily really become the darling of all the asset classes, and then you saw rents firm up, and if you look at the other side of the chart, it went up. And that's why I provided those charts, because we have to have an outlook kind of where we are and where we're going. One thing's for sure, it took a long time for the government to recognize that we had a problem. And now they're overcorrecting. So my approach and my outlook is that we are going to overcorrect. We're in that process. We're not at the bottom yet. We're probably getting there. I think the first quarter and the second quarter of this year, we're going to kind of be at the bottom. The government will overcorrect, despite, Robert's outlook to interest rates, quite different than mine.
I don't have an outlook on interest rate. I just said I can't predict them.
Well, that's not helpful.
Well, I can't. Listen, I know I can't dunk
He
a
doesn't
basketball.
take any positions where he's held responsible. I'm taking a position, okay? So I would say we're going to overcorrect. I think there's going to be a lot of discovery. When there's finally discovery, it's over-discovery. So if people can get their assets in order, really focus on managing what they have, getting themselves into a great position in the first and second quarter, I actually think 2023 is going to be one of the best opportunities to aggregate multifamily assets. That's my view, right? Liquidity is going to be tight. A lot of people in the audience are going to be a little fearful, like, oh no, it's going to keep going, it's going to keep going. That's always the time when you're at the bottom, right? The world works in funny ways. It's like counter-psychological. When you're at the top, everybody says things are only going to get better, right? Like we said like 6 to 9 months ago, oh, only going to get better. We're going to have 3 caps, not 3 3/4 caps. When we're at the bottom, it's the same. When we're at the bottom, it's the same way. When people say, "Oh no, this is terrible. We can't invest," that's the time to invest. So I actually think going into the first and second quarter, if you have your house in order, if your assets are doing well, and I want to touch upon that with the agencies in a minute, that will be a great time to aggregate assets. You may not make a current return, right? But you're not in it for the moment. You're in it for what may happen. And I do believe there's going to be a great run that's going to be a 5 to 10 year run like we had, 10 years ago. So that's the way I'm looking at the world. Robert, you have an opinion?
It sounds like Arbor's for sale. You're like smoking like a great originator. Like we're going to have record volume and no. Again, the question is, this is so above my pay grade. If you really think that's going to happen, can you make the same return? Can the investor make the same return buying some apartment REIT stock, right? At the end of the day, if you think cap rates are going to go down, and right, can you, if you're an LP in one of these deals, are you better off just buying, Amco and getting that benefit and having liquidity? I don't know. Those are the things that a lot of people who invest in these markets don't think about, right? Is what else can you do?
It's not an either or. A lot of the people in this room are active investors. They're very active with their real estate. It's part of their livelihood. There are a lot of people who bought the B REIT, the Blackstone Mortgage REIT and the start. And you know what? That's a passive investment, and you have no control over those investments. In fact, we were just having a discussion last week. Those are the only REITs that are still increasing the value of their assets when assets are going down. Who wants to be in that position, right? So if you look at those non-public traded REITs, they're still increasing the value of their assets when their assets are down 20, 30%. You have a different group of people here. You have a group of people who do take a directional view, understand the market, understand the fundamentals, right? And I think what I try to do a little bit is provide some fundamental analysis of where we are, looking back at things. The agencies really do lead the way, and when they get aggressive, it does make a big difference. How are you guys going to deal with if you have defaults coming your way? You've always had the lowest level of defaults, even through COVID. What's the FHFA, and what's the outlook in terms of how you see your portfolio performing? Because that creates a lot of direction in the market.
Yeah, I can't speak for FHFA, but I can speak for us, for Fannie. Our portfolio is still operating. The numbers are still strong. Our debt service coverages are still, at a high level. Right now, our leverage is still low in the overall portfolio. As far as, what I'll say, seriously delinquents or defaults, it's basis points, right? And, through COVID, worked out most of our issues. Definitely, the hangover, as we all know, is more than likely going to be specific to a product type. But the way we're going to approach it like we always do, right? If we need to move people around, we're going to move people around. It's direct contact with not only the lender, but the borrower, right? To know that we're here to work through things. We did in COVID there were some loans that, we gave the forbearance, extended out the time, added, people made payments towards or were paying interest only. So, as far as, again, someone who acts or has acted appropriately, we're going to see what we can work through. But working through, to be honest with you, is not a DPO. It's not an adjustment somewhere down, right? It's simple in our philosophy. We lent the money, you need to pay it back, right? And, as Rob said, and, I've said before, we weren't your joint venture partner on the way up, right? We're not going to jump in as your joint venture partner on the way down, but we're going to look at the loan, look at who we have in front of us, and work through what we need to work through.
So if history repeats itself, which this chart tells you what's going to happen, you're going to see unemployment change, and you're going to see a rise in the unemployment rate, which should lead to a softness in rents and should lead to some economic, vacancy. That's what should happen, right? And then there'll be a correction. And I think it'll happen quicker than people think. And I think when you see that happen and you see that correction going, I think that will be the bottom. Because we need that correction. We need the supply chain corrected, right? We need rents to be brought back in order to inflation to be under control. When inflation gets under control, then we'll see some stabilization in the market and stabilization with rates. We've seen the largest increase in rates ever in the shortest period of time. We now see rates at the highest level they've been in 2 decades, right? That's not where I think it's sustainable, because once we hit bottom, you're going to need rates to be a stimulus for the economy. And contrary to Robert's neutral point of view, I believe that's really what's going to happen. And that's going to be the land of the greatest opportunity in multifamily. We've lived through the greatest opportunity in multifamily. We lived through it twice. We lived through it from 2010 to 2019. Then we got a little scared. And then all of a sudden, rates dropped, stimulus in the system, and then we were all believing that things can only get better and better and better. You couldn't even fathom it. A lot of people were smart. They sold at these elevated levels. We have a correction. I believe this correction is a great period of time for all of us to get recalibrated and get readjusted. But through this correction, we got to get our house in order, and that's why Robert's going to make a really good living. He may end up in Switzerland somewhere. And FM Capital is going to do very well. And hopefully, Fannie Mae will provide the liquidity in the system. Anything else the panelists would like to offer up?
Yeah, it was just one thing, because I agree there will be a time that people can capitalize on it. But in this interim period, if you're an asshole, it's going to tail with you for a very long time, because everyone speaks nowadays. It used to be last cycle, if you had a defaulted loan with Freddie, you can probably go to Fannie and get through and no one would know. It doesn't work like that anymore. Everyone speaks to everyone. Everyone's selling their bonds to one another, talking about it, leveraging with the same places. So being open and honest and being a mensch for all, is so important in a bad time, because everyone's feeling a pressure. So, not adding to it and coming out in such a contentious matter but really looking at it as a partnership with your lender, because you're in it for the long haul.
Yeah, I think that is really worth talking about and noting, because if you can't borrow from Fannie and Freddie on a multifamily side, you might as well exit the industry. you'll lose one of the most major competitive advantages and liquidity sources on a long-term basis. So if you have a big bump in the road during this dislocation and you ruin your credit, the agencies are not like it was 10, 15 years ago where they didn't have data, they didn't share data. It's all out in front of them. It's all very transparent. So I would urge everybody, to work the system through if you want to stay in the industry, because without access to the agencies, you're going to have a tough time being active in this business. Point well noted.
Yeah.
All right. With that, I'd love to open it up to some audience questions and some participation. I can't see.
No.
But you speak up a little, please.
I said I don't have a question, but really just an observation. Really, you said I don't watch over your portfolio, and for the next the area that you can touch on is operation. Everyone's insurance is going up, geometric proportions. Everyone's utility bills are going up in geometric proportions. Taxes in certain areas, but labor has been crazy, with inflation. It's tougher to find people, and when you find them, it's more expensive. So that's something that needs, we can't control interest rates, but we can control, our own operations, get to know your operations. We've got 21,000 apartments in 14 states, and we watch them like a hawk. And my advice, similar to what you said, Ivan, is you can't control where rates are going to go, but you can control your portfolio and to watch internally as to exactly what's going to happen there.
I think that's well noted. I mean, execution, management, operations are essential. We have had the benefit, which I didn't really point to, is that we've had a 15 to 20% increase in rental rates, and that's occurred over the last 2 years. There's no denying that. Mm-hmm. And those increases in rates have offset the increase in interest rates to some level. But without the execution and the efficiencies and managing your assets, you're not going to get through it. You need to create great management and great execution. For the people who have done that over the last 3 years, they're in pretty good shape. For the people who haven't, they're going to struggle. So I can't emphasize enough, even as we as lenders work with borrowers, we do look at their capability. We look at how they execute their game plan. We have a lot of projects which we're invested in ourselves, and we took a position around 12 months ago to stop all construction and wait it out. It is our view that labor costs will come down and goods and services will come down. They're up 30%, 40%. So up 30 or 40%, it's hard to make that back. So I do believe there'll be a leveling off, and good operators will do a much better job managing their costs and managing their projects and getting through this very well.
We have time for one more question.
Okay. Rob.
Yes.
First of all, great panel, everyone. I couldn't control myself. So if the guy's not a mensch and he is a thief and he has no capital to put in, are you still taking that assignment?
No.
Okay. All right. That's a good answer. That's it.
We say no to way more. If a guy argues about my upfront fee, then he's definitely not, he doesn't have any money to pay my upfront fee. He doesn't have any money to fix the problem. So no. We've fired guys who have stole rents. We have fired guys who have just done bad stuff over the last 12 years. Yeah.
I don't really mean it. What I meant to say is he doesn't have cash.
No, there's nothing. I can't. I'm not going to get a deal done. If he doesn't have cash to put into the deal,
What do you advise that time? Give the keys back?
hire someone else or. I don't know. I mean, typically,
Co-GP with
yeah,
someone.
typically
How much equity's in that property? Was he willing to give up? Right? If some cash comes in from someone's looking to help him. Saying they don't have any money is one thing, but is this property equity? Where is it located? What kind of condition it is in? Right? How do you wind up in this situation? But right, you got to pay someone like him fees. If not, they're going to go to someone like you as a broker, right? So you can get your point when your 100 basis points when you find them some equity.
Yeah, I just think it's so tough to raise that guy equity for a transaction to actually happen. And all we do at the end of the day is we have hours to sell, right? There's only a certain amount of hours in a day. So we would pass on that.
And it's all reputation and, and relationship. When you go to approach a lender, the lender wants to talk to you because you have a solution. So, you know, and if you don't have this, if you take on people that are just going to run you ragged, it makes you look bad and it hurts your pull through for other deals.
It's true.
So.
And the one thing I'll say in all scenarios is anyone here who's an owner, if you get advice from someone who says, well, don't pay your Fannie or Freddie, and I'll even say Freddie mortgage, because this way we'll get them to the table. Yeah, you're going to get me to the table with my attorney's notices and everything else.
I think something's worth noting with.
But hold on a second. But
what?
And
don't point at me.
And that
Don't
guy's,
point at me.
there hasn't been a workout that we have done where the lender's first, just tell your guy to pay else I'm going to take the keys. That's every lender's first opening salvo, and typically they, if you keep them current, they'll do a deal. But like every lender's like, if you don't pay, you don't pay, but they'll still do a deal if it makes sense.
But you got to be current.
Not all the time.
With us, you have to be current.
Not all the time.
Oh, wow. Really? Well, here's what I'll tell you. From November of 2018 to now, yeah, you got to be current.
That's when you made the jump.
That's when I made the jump.
Listen, I think we have to take a look at this dislocation versus the last one in 2010 where Robert made all his money. You have to understand what he did. He created all these loans and CMBS packages, right? and then he ended up restructuring with the special services, and he knew all the sides of the coin.
Wow.
But this is quite different because back then, all the loans were securitized into bonds, and all the special servicers got themselves in a position where all they had to do was make fees. They didn't care about anything else. It was really a fee generator without the economic value of the asset. This is a very different set of circumstances. This is where the lenders who are involved have a real interest in the loan. They haven't transferred the interest in their loan. They understand the value of the assets. They do have relationships with their borrowers. So you can get to the table and work out good solutions. And that's the very big difference between this period of time and last. I'd like your view on that, Robert.
Yeah, listen, every moment of distress has a different game plan in terms of what's the appropriate workout, right? When the special servicers own the bonds and they were the special servicers, then the special servicers were just a fee servicer, but some hedge fund owned the controlling class. Then you had the fair market value option. Right now you have Fannie and Freddie. How are they financed? Are they incentivized to kick the can? The lenders usually tell you their game plan when you first call them up. Like they tell you what they can do and what they can't do. And it changes all the time. It definitely changes, whether it's a balance sheet lender or a life company or Fannie or Freddie or CMBS.
I mean, especially in workforce housing, I think it's in everyone's best interest to work out a deal quickly. Because if you have a 1970s vintage asset, C class or B minus, whatever you want to call it, like C goes to Z very quickly if no one's watching the store. So, your property is worth 100 a door, it's worth 20, in 6 months if no one's paying attention.
Everybody wants to know where the 20,000 a door project is.
Used to be Atlanta, now it's 200,000 for the same property. So.
Okay. Any more questions? Okay. Thank you, guys.